ESG investing is now one of the most prominent themes in global markets. Environmental, social, and governance. These three factors have become key standards for judging corporate value. The numbers highlight its scale. By 2024, global sustainable fund assets had reached about $3.2 trillion, more than 4 times the level in 2018. ESG assets now make up more than 15% of global investments. Europe leads this trend, holding around 85% of global ESG assets. Strict EU disclosure rules have directed capital toward renewable energy, electric vehicles, and clean technologies. The United States also drove the early boom. Between 2020 and 2021, ESG ETF assets tripled. But momentum has slowed. In states like Texas and Florida, ESG is criticized as political, and in the first quarter of 2025 alone, about $8.6 billion flowed out of ESG funds. In contrast, Asian markets such as Korea, Taiwan, and Thailand continue to see strong inflows into ESG investments. Performance has also been notable. Since 2018, returns from ESG funds would likely have outperformed traditional funds. In the first quarter of 2025, leading ESG funds rose 2.09%, while the MSCI ACWI fell 1.58%. Still, not all companies deliver on sustainability. Concerns over greenwashing, firms that promote ESG only in words, continue to rise. Investors now demand concrete results, transparency, and accountability. ESG is no longer a passing trend. It is becoming a selective market, where only companies with real responsibility and measurable impact can survive. The EU is tightening standards to improve reliability, while some firms are choosing silence, a phenomenon known as greenhushing, where companies hide their ESG strategies to avoid criticism. In the end, ESG is not a bubble. For companies, it is a survival strategy. For investors, it is a standard that cannot be ignored. ESG has entered a new phase, where its true value must now be proven.